Hi, welcome to the first of a number of questions with answers using Microsoft Excel on ratio analysis. Okay, hopefully useful video for those of you studying business and or accountancy. We start with fairly straightforward questions where the data given is pretty well abridged. In other words, it's already been drawn for us. And as I work through different problems, we just have to work a little bit harder on extracting the relevant data. If you haven't already done so, please stop the video and study the data set out here. Okay, well, if you've studied data, we've got a company with some straightforward data, and we're asked to, and we're going to look at a number of different ratios. So without further ado, let's get going. Let's start with the gross profit margin. Right, well, the gross profit will be the difference simply between the business's revenue and its cost of goods sold. So let's start with the revenue. Okay, well, that's given at 2 million. So there's our starting point. And I've already said we also want the cost of goods sold. And that's given to us. So the gross profit is the revenue less the cost of goods sold. So this figure is the gross profit. Now, the reason for expressing it as a percentage is we want to see the relative profit against the revenue. So we just take the gross profit, divide that by sales, and most important, express it as a percentage. So we can see that we've got a figure of 40%. So that's my gross profit margin. Now, what that tells us is that for every $1 of sale, we are making 40 cents profit, but only against what we paid for the goods. What it doesn't include is all the expenses that go into actually selling them, the transportation of the goods, the delivery of the goods, the processing of the goods, paying staff to manage, and so on and so on. So what we do is we might find it might be better to drill things down a little bit and have a look at the net profit margin. Well, very, very similar. We compare the profit against the revenue. Now, as I said, it looks like it's fairly simple because we're actually told what the profit is. It's 500,000. All right, well, what's the revenue? Well, that's no different to what we had before. And what is the profit? Well, it's 500,000, so the profit before tax, 500,000. Now, you could actually work out what the expenses are from this, and I'll come to that in a second. Let's just answer the question first. So if I take the 500 and I divide it by the 200,000, I will get, once I've formatted it as a percentage, 25%. So after all the expenses, we will be making, for every sale of $1 sale, 25 cents. Obviously, $100 of sale gives us $25 of profit. Okay. Okay, well, just out of academic interest, the expenses I could actually work out because the expenses will be the gross profit minus the profit before tax. Okay, and you've got to wonder whether, in fact, you need that. In future ratios, definitely yes, because sometimes we like to measure our expenses against other aspects of running in the business. And really, it's a measure of efficiency. Okay, I did say, is this a good thing or is it a bad thing? The answer is we cannot judge that easily. For example, if you were selling high value goods, such as motor vehicles or expensive computer equipment, you might not regard 25% as particularly good, especially if you're only selling, say, 1 or 2 cars a week. You ain't going to be making much of a living. So, whereas compared to, for example, a grocery store or a supermarket, I'm thinking of high street big stores like in the UK, Tesco, in the US, Walmart. You go and have a look at their websites and you can work this out for yourself, and you will find that their net profit margin is way under 10%, nothing close to that. And these are highly profitable companies, well established in their markets. And you can hardly say, well, oh, low profit margin, that can't be very good. Well, it is. They're in a highly competitive industry with a vast turnover. And this is the point. We haven't got enough information to make those kind of judgments. However, what we can say is the fact that it's positive, in other words, it's a plus figure. Well, obviously, you're not dealing with negatives where you're making a loss. Okay, well, what about this next figure here? Return on capital employed. Now that might be actually quite an important figure, particularly if you're a shareholder. Now, what this is looking at is the relationship between the profit, which we now have at 500,000, and the value of the shareholder's equity. In other words, what the shareholder or the owner of the business is actually worth. Well, the shareholder's equity is here. So, if you imagine you are the owner, the only shareholder of the business, your investment in that business is now 1,300,000. So what return is that giving you back? Well, let's just measure that as a percentage. Quite simply put, profit before tax divided by that figure there, expressed as, of course, a percentage. And we've got a figure of 38%. Okay, and if you just wanted to be a bit fussy and do it to 2 decimal places, 38.46%. Now, that is good. For every $1 you've invested in that business, it's giving you back 38.46. Is it good? Is it bad? It looks good on the face of it. If you put that money into a deposit account at a local bank, you're not going to get anything in, a fraction of that. All right. And interest rates in certainly when I was writing are not, huge at all. They were 5% when I was looking, and they're not likely to increase much. Okay, so all these ratios have one thing in common. They have one thing in common. They're called profitability ratios, or percentages, of course. And they try to measure how well our business is doing. So I seem to be sort of fairly aloof about is it good, is it bad? Well, if you really want to make a better judgment, then you should compare it either with other businesses in a similar market of a similar size, or, and this is important, to compare like with like, maybe look at last year's. Has it gone up? Has it gone down? So it's really important to get more information about, as I say, either comparing it with other businesses in a similar situation or a similar size, market, so on, or compare it with the past. Okay, well, we've got three more ratios to go through. So let's have a look at this one called the current ratio. Okay. Well, the current ratio, it is a ratio. So we're looking at something very different. It's just current assets divided by current liabilities. So I'm looking for my current assets. There we have it. Fairly detailed information there, because as we said, it looks there, it doesn't include the inventory. Well, I'm not interested. We'll need that next time. So the current assets we've got as 800,000, and then I want the current liabilities. That equals 400,000. Right, we've got a very, very easy figure. Now, all you do is it's just current assets divided by current liabilities. And that gives us, now it's quite important here to format that as a number. Okay, so what does it actually mean? Well, what it means is that we're able to cover with the current assets. Remember, the current assets is going to be mainly comprised of the inventory held by the business, the cash held by the business, and any money owing to it. Now, that you're likely to recover within a short period. Usually, we would say within a year. So I would say this is quite healthy. We're normally looking at a figure of about 2 to 1. So we haven't got much of an issue. Okay, but what is this thing here? It's very, very similar. Very similar indeed. The difference is we don't include the stock as a liquid asset. So what we do is we take that figure by all means and remove the inventory or stock. I keep calling it stock. We are talking inventory. So what I'm going to do is take that figure away. So, right, okay. So we know that that is 800,000. We've also been told that we've got 300,000. So in fact, I'll call it liquid assets, for want of a better term. So what have I got? Okay. I've got 500,000. So why not include stock? You might ask that question if you haven't already. Well, the point is, just imagine you go into a grocery store or your local supermarket and you look at the shelves, and yes, you are looking at inventory. And yes, it is fairly liquid because that stuff's going to clear out through the checkout very, very fast indeed. You just stand and watch. It's moving all the time. However, as soon as that's moved, at the back of the store, almost certainly there's a new level of amount of stock now coming back in. The point is, the stock, without stock in a supermarket, it by definition is not really a supermarket. It's just an empty shell of a building. So the stock is virtually semi-permanent. You can't run a business without it. Now, if you go to a manufacturing concern, again, the raw materials that's needed in order to produce the products or the semi-finished goods, again, you're hardly going to be able to run a factory or any kind of manufacturing concern if you've got no stock. So by removing stock, we have now what I've now just named as fairly liquid assets. So that might be a better measure to tell us how easily we can settle our debt. Yes, you can settle debt by not having any stock, or by clearing, selling all your stock. But fine, that's called liquidating your business. Okay, and you may not have anything left. So what I now want to do is, yeah, I've got my liquid assets. Let's stop messing around. Okay, well, sort of like I sort of do them with spreadsheets. Not always good practice when you're trying to show others how to do it. Okay, but what we said is we want the current liabilities in exactly the same way as I did up here. Nothing's changed in that respect. And really, I'm just applying exactly the same principle of dividing this liquid assets by the current liabilities. Now we can box that in. And we can see that we could cover our immediate debt by 1.25 times. So we would more than cover it. And indeed, we are looking at a figure of 1 and a bit, 1.5, 2, 3. Of course, you can have far too much cash swimming around in a business, and maybe that might not be too good. So I would say that this business is probably in a reasonable position. Okay. Finally, let's have a look at this one. Let's bring that up here because it's slightly hidden on my. Okay, debt to equity ratio. Debt to equity ratio. All this is it compares the amount of debt the businesses has against what the business owners are worth in terms of their investment. Okay, so and you see a business is financed, keeping it simple, in one of two ways. Either the finance has been provided by the owners or you borrowed it. Okay. So were you looking at a figure? I mean, if you've got a figure of 1, for example, it would mean that for every dollar that you have invested in the business, you also have $1 provided by an outside body. So I kind of guess I'll hopefully get a figure of maybe less than 1. Okay. Later on, we'll look at a concept of gearing in another lesson, and that tells us the ratio proportion of finance by that is in fact been lent rather than provided by the owners. Anyway, what we're going to do is let's look for the debt. Right, well, we've got the non-current liabilities, and also what we're looking for is the current liabilities. So the current liabilities is the short-term stuff. All right, so there's my current liabilities, 1.5 million. That's a lot of current liabilities, but the non-current liabilities is relatively low. But it's a debt is a debt. Whenever you've got to pay it, you've got to pay it. So we've got, if you like, two lots of debt here. Current liabilities and non-current liabilities. Non-current liabilities, right? I've taken the wrong figure. That's why it's important to read this carefully. So what I've actually got is 1 million borrowed money. Again, I'll repeat myself. Yeah. Liabilities is the key word I want. Okay. These are the two amounts of money that we owe, if you like. Current liabilities, we've got to pay it relatively quick. Non-current liabilities could be a bank loan, it could be a mortgage. There are many ways in which you can borrow money, or debentures, which is also a form of borrowed money. Well, let's compare that against shareholders' equity. Okay, so we want shareholders' equity. Just pull that figure across. And we've got, so we already know that we own more than we owe, if you like, in the business. So we will get a figure less than 1. So I'll take a shortcut because I know the format's right. There we are, 0.77. So it's less than 1. Okay, that means we're not probably not over financing the business through borrowing. Why is that a good thing? Is it a bad thing? It's debatable. But if interest rates are fairly high, that's going to be quite a big burden on the company. You just go and ask a government, when they've got huge amount of national debt and interest rates go up, so do their costs go up. It's the same for a business. It's the same for a household. If you have a heavy mortgage and interest rates go up, not good, you see, because you've got a lot of interest to pay. And exactly the same applies for the business. Okay, well, when I explained that this was profitability ratios, we have another general term for this as well. And we call it liquidity ratios. Okay. Well, hopefully that little introduction's been very useful. And watch out for the next one. Okay. Thanks for watching.